Morning, members. Welcome back for this 2 days conference on recent updates on Companies Act. We have with us our beloved CA M P Vijaykumar sir to develop on the subject Schedule 3 Corporate Governance versus Ease of Doing Business. Can I request CA CP Jain, MC member, to escort CA MPV sir onto dais and then welcome him with floral bouquet. Thank you, sir. Members, I am privileged to introduce my guru, CA M P Vijaykumar sir, to this August gathering. CA M P Vijaykumar is engaged with passion, pragmatic envisioner, and a proven executor. Over 30 years of experience in industry and as a chartered accountant in practice. Presently, since 2007, he is executive director and group CFO of CFI. He was partner of Yoganand and Ram LLP, chartered accountants. And then he was head investments, banking and company secretary, subsidiary of Sundaram Finance. Presently, he is holding the directorship in LIC of India as independent director and also chairman of audit committee. Geojit Financial Services Limited, non-executive independent director. Heritage Foods Limited, non-executive independent director. Sella India Software Services Private Limited, non-executive chairman. CFI Singapore Private Limited. And former directorship he had in national. Okay. Sir was 2 times Central Council member during the year 2016 to 2022 and was heading as chairman of Accounting Standard Board and many other boards. With this brief introduction, I would like to present before you CA MP Vijaykumar sir. Over to you, sir.
February 22, I was supposed to be here when Divya took over the chair, but unfortunately, due to some commitments, I could not come in. But I'm happy that I'm here again at this city and amongst all of you. Thank you all for joining us fairly early in the day for a topic which is not a completely new topic. It's a topic which all of you are reasonably familiar. So before I get to the topic of Schedule 3, I just wanted to share with you that I would confine my focus largely to the recent amendments which have happened in Schedule 3. It's recent in the sense that it happened in 2021. The first financial year when we applied the amendments was 21-22 and 22-23, the just completed year. Almost all of us are in the stage of finalizing the financial statements, given that we are 3 months after the financial year end. So I thought I'll focus essentially on those amendments and synchronize it with the expectations of the Ministry of Corporate Affairs when these amendments took place. I was fortunate enough to be a part of the deliberations when these amendments happened. And almost all of the amendments, if you look at it, they're all focused entirely on enhanced governance, ensuring that companies are managed much better. These requirements look a little onerous for us, but let me share with you my experience, at least after the previous year implementation and interaction with people. Everybody finds these amendments a welcome amendment because it's helping them to get more comfort in the process of both preparing financial statements and giving assurance as well. So all of these amendments which have taken place, including the CARO 2020 amendments as well, are all directed towards improving the governance requirements of the companies. And for those of us who are in practice, companies which are well managed, companies which are well governed, the audit risk comes down. And hence it is important that as professionals, we should encourage companies to keep enhancing the quality of governance practices they have. And that DNA of good governance in the auditee will reduce our audit risk and consequently make audits more effective and enjoyable as well. I'd just like to draw your attention before I go further to the bottom part of this slide, which basically is MCAs, the Ministry of Corporate Affairs, their own statement of purpose, their own purpose of existence as defined by them. So most of us have a habit of seeing MCA as a regulator who's trying to source information, trying to sort of intrude. But my experience, at least the 6 years when I had the opportunity of engaging with them, the consistent tone which they had shared across all the senior leadership of the ministry was, whatever we do in the act or administered through the rules, all of it should focus towards empowering the businesses to be successful, empowering the businesses to be successful. So for us at a distance, it looks like they are probably a little onerous, they're pretty difficult to comply, the compliance are going up and things like that. But the thought process of the leadership, at least from my interactions I've always got, is they wanted to ensure that businesses stay empowered, and towards this empowerment, they took upon a few subtasks, which includes tasks like, sorry, it's here. So tasks like the being a regulator one, obviously, but equally important to be an integrator for the various legislations which are there, facilitate businesses and also educate. In fact, I don't know how many of you are aware, the Ministry of Corporate Affairs has an extended arm called Indian Institute of Corporate Affairs, through which they continuously keep doing programs more for the director's profile to help people to understand law and help businesses to be run much better. So it's in this backdrop that all of the Schedule 3 amendments needs to be understood. While I introduce these amendments, most of which all of you would have complied with in the last year when the financial statements were prepared for March 22, I just want to draw a quick reference for and getting a perspective of what corporate governance is and the objectives of ease of doing business. One single slide where I'll highlight on 2-3 aspects, so that I can connect, the Schedule 3 aspects with the corporate governance elements. Now, as far as corporate governance goes, it is essentially nothing but the way businesses are managed to take care of interest of all the stakeholders. All the stakeholders' interests are, they look a little conflicting or diverse, but eventually all of them want a sustainable business and a healthy business, whether it is stakeholders in the form of a customer or a supplier or a lender or a shareholder. All the stakeholders eventually want a business which is sustainable and a business which is healthy. So in that context, there is governance is nothing but the way you run the business so that all the interests of stakeholders are pretty well aligned. And for this, there are a set of objectives they are supposed to achieve: protecting the interest of shareholders, ethical business conduct, autonomy in the way your business are expanded and all. You need not run around too many registrations or approvals and all. And how do we become very strategically effective? I'll just focus on one element, which is the improving commitment to values, ethical business conduct, and transparency. So everything around Schedule 3, and typically the task with all of us, either as preparers or as auditors, are connected. There it is focused entirely on how much of transparency we can bring for the stakeholders to understand the way the business has been performing and how ethically the business is being conducted. I'm sure all of you are familiar about the NOCLAR provisions, which became effective from October 2022. non-compliance with laws and regulations as part of Code of Ethics. It has become effective from 1st October 2022. End of the presentation. I'll spend about 5-10 minutes. I'm sure many of you must be aware, but it is mandatory, effective October 22, and in a phased manner, it will be made applicable for others as well. You're all aware in the recent past, particularly the last 1 month, 2 months, there's a lot of interaction happening where the legal professionals are required to inform the government if anyone has approached them, if any client has approached them, where the lawyer gets a sense that this entrepreneur or this company is trying to violate the laws or non-complying with the laws, the government is making an effort to see if the lawyers should proactively report to the government that there is an entrepreneur who is planning a evasive method or a company who is trying to avoid a compliance with legislation. Now, while the legal profession, whether they will eventually embrace that, whether it is practical to do that, that's a different subject, but that's the current thinking it's happening in the government. So in this backdrop, as far as our profession is concerned, we are already mandated by our code of ethics, for which all of us are bound by, non-compliance of which leads to disciplinary action, including removal of membership. The code of ethics now requires from 1st October 2022 that if we come across, if I am a senior accounting professional as an employee or a practicing chartered accountant, if I come across a non-compliance of a law or a regulation by a company, I am legally bound to inform the respective regulator that here is the company which I am working, there is a FEMA violation which is happening. Despite the fact that I'm an employee, I am required to inform the regulator concerned, the RBI in the context of FEMA, that this particular violation is happening. So that's the obligation all of us carry as chartered accountants in employment and in practice as well. I'll share some thoughts on that as we go along. So the second element of the objectives of corporate governance becomes important. And the key aspects of corporate governance, there's several, which includes accountability, transparency, objectivity, independence, and several others. I'll just focus on one particular aspect, which is on independence. All of these terms and the meaning of those, how they are to be applied, all of you are familiar. But I'd just like to spend a minute on independence. So independence, all of us also are aware that it is a state of mind. And I'm strongly of the view that while some will argue that independence will come only if appointment is done by a third party, I don't believe, at least my personal belief, and we can agree to disagree on that. The appointment will not decide whether a person is independent or not independent. If that was the case, all the C&AG appointment audits and the erstwhile public sector audits, the independence should have been at the highest, and there's enough evidence that we have not witnessed the same. Independence is all about the state of mind of the professional who is engaged there, and the professional's own confidence, competence to stand up and say that I'm independent and I'll be able to express myself wherever I need to express. Now, as far as independence is concerned, one is acting independent and also appearing to be acting independent. Acting independent and also appearing to be acting independent. So when it comes to independence, whether it is a Companies Act or our institute rules, there are some fair amount of prescriptions on. If you have shareholding less than this, due so and so, all these, there are some prescriptions and all, but these prescriptions are intended to be the minimum prescriptions. These are supposed to be the minimum prescriptions, and those should not become a checklist to say that I followed this checklist and hence I'm independent. That is not the test of independence. The test of independence actually comes from what we have in the code of ethics. where we have independence in terms of we don't have, for example, an advocacy threat. So the many instances where we give a particular position, we give a particular advice, and because we have given that advice, tomorrow we would like to do whatever it takes to stand by that particular advice. So the ability to say that, yes, I am a statutory auditor, I will stay away from advisory services because tomorrow I have this advocacy threat where I have advocated a position and I have to comply with that particular position. So those kind of threats are what we need to come out of. And my own view, as far as the listed companies and large public interest entities are concerned, while the regulations might permit some amount of non-audit services to be done, it is very important that from a principal perspective, if you want to be sustainable in the long run, particularly for listed companies and large public interest entities, we should stay away from non-audit services if you are a statutory auditor, because the moment you pick up any non-audit services, you will always end up with a situation of an advocacy threat, where you have advocated a position earlier, and you will be sort of bound by the fact that that position you have taken, and consequently you need to subscribe to that particular position. In the case of non-public interest entities, which is the majority of entities, in my view, it doesn't matter. Matter because 80-20 principle, all of us should be considered about those which are material, and those which are material are typically the public interest entities and the large non-public interest entities. In fact, on large non-public interest entities, I want to share with you a very interesting development. If you look at across the world, public interest entities always have been listed companies, and the banks and insurance companies, only they are defined as public interest entities. In UK, now they are looking at including large non-public interest entities also as a public interest entities. For example, in India, we are all aware that enterprises which have unlisted companies and a net worth of 250 crores, you are required to comply with Ind AS. Across the world, IFRS is applied only for listed companies, whereas in India, we have made it applicable for unlisted companies with net worth as small as $30 million, 250 crores. So while India did this in 2014, across the world now the developments are happening where they are sort of emulating the India practice and saying that even though you may be an unlisted company, the size of the business is material for the economy in terms of employees, taxes, so many other loans which are there, and consequently the unlisted entities which are large in size should also be considered as a public interest entity. So that's a development which is happening globally. In India, we have embraced it almost 7-8 years ahead of time, but I'm just sharing this to tell you that there's some of these practices like CSR. India was the first to make it mandatory. Other countries are all now following suit. Here also is another example of what India did ahead of time, and the other countries are following suit. Now, last is as to why effective corporate governance. The reason for corporate governance, at least my experience of the last 30 years, almost all the entities which have failed, all the companies which have run into some scandals, almost all of them have failed only because of poor governance practices. Very rarely you will come across a situation where company had a failed business model or an external environment which made it difficult to survive. It all failed only because the governance practices right from the board up to senior management or middle management failed. And if you do a research of any case of a scandal where a business had to be shut down, you will eventually end up putting a finger only on the fact that there was a governance failure. And for this reason, governance becomes pretty important. Now, as far as the existing practices for improved governance are concerned, in the Companies Act, there are several provisions relating to governance structure, the committees, related parties, so on and so forth. But for our fraternity, what is important is to give quality, transparent, reliable financial information. Quality, transparent, and reliable financial information. That is also one of the key elements of a good corporate governance. So as a preparer, as an audit committee, as a board, and as an auditor, all of us have this responsibility for ensuring good corporate governance. That financial information should be qualitative, transparent, and something which can be relied upon for decision making. And when it comes to the players who are key for corporate governance, while you have the board and the shareholders also who oversee governance, independent professionals like you and me, whether we are in employment or whether we are in practice, are equally responsible for ensuring good corporate governance. And I want to, even at the cost of reiteration, state that the Ministry of Corporate Affairs, my entire 6 years of interaction with them, they have consistently said one statement, that if there is one set of professionals whom we can rely upon for improving governance in the country, it is only chartered accountants. And chartered accountants' role is essentially in the context of financial statements, and wherever they are employed or as a board member, it is only through these professionals that we can enhance the corporate governance. And if you look at the Schedule 3 amendments which have taken place, most of the amendments which are there are targeted towards ensuring improved corporate governance. The same applies to CARO as well. Now, let me come to the core of the topic, which is Schedule 3 of the Companies Act. We have 3 divisions, all of that stuff you are familiar. Division 1 for non-Ind AS companies, Division 2 for Ind AS, and Division 3 Ind AS for non-banking financial companies. All of the amendments in Schedule 3 broadly fall under 4 buckets. All the amendments, if you take, they'll fit under one of these 4 buckets. One bucket is enhancing disclosure for improving corporate governance. There's a set of disclosures which I will elaborate in detail. So there are a set of disclosures like promoter shareholding, change in shareholding, the way you deal with MSME outstanding, aging of receivables, aging of capital work in progress. In fact, in the same 6-year period, I would have gone through about 800 annual reports, either in FRRB or QRB or in the research committee, 800 annual reports. And many cases, we used to find this situation where substantial amount of money is used to sit in capital work in progress or intangibles under development. Those which kept on increasing, they never got completed. They were nothing but expenses which should have ideally hit the P&L, but they were sitting as capitalized figures. They were all getting aged, and at some point they would go through a restructuring scheme and write it off against some reserves and things like that. So to plug those loopholes, we now have the aging of capital work in progress, cost overruns, time overrun details, and any capital work in progress which is suspended. I am not pursuing that project at the moment. So all those details need to be given. Those details do not change the asset values, do not change your net profit number, but that particular disclosure will ensure that there's a higher level of governance, because people will observe, why is there a capital work in progress more than 3 years? Why is so much time overrun? Why is so much cost overrun? why is a project has been suspended. Now, who is going to give all this information? The preparer, audit committee, board, and validated by the auditor. So there are at least two sets of chartered accountants, one at the preparer's level, other at the auditor's level, who are validating this information and making it available. So one set of disclosures are all aimed towards increasing the level of corporate governance. And just one more background, if you are not aware, this entire disclosure requirements originally started off with amending the CARO, for those who are familiar, right from 1988, its journey has been, the CARO has been increased in terms of the extent of reporting to be done. But in 2016, CARO was shrunk substantially. It was shrunk substantially and made minimal. But unfortunately, in those 4 or 5 years, when the CARO reporting got shrunk, the extent of accounting gaps grew significantly. And all the regional directors of the Ministry of Corporate Affairs literally came up in arms together saying that CARO has to be made a very effective tool where auditors can proactively inform us that these are the things which are not happening the way they should happen for the ministry to follow through in terms of actions. So CARO 2020 was originally drafted, and CARO would have meant only auditors in practice to respond. And some of these clauses were so difficult that the preparers would not cooperate with the auditors, and hence CARO was held back. Schedule 3 was amended to say that preparers should first give this information. So the obligation to give the information was added in the preparers so that auditors can report on that. And this whole twist happened with the institute's effort, where the institute told the ministry that, look, our members can report if the preparer has given the information. And hence Schedule 3 was amended to add all these clauses, so that the preparer will give it, and the auditor can consequently make a report on the same. Similarly, also on money laundering, there was a need felt for early signals. Ever since the IBC law came, and I'm sure all of you have witnessed either through media or in your practice, balance sheets of 31st March 2018 was signed in August or dated August. Balance sheet of March 2018 was signed, dated as August. And in October, the company went into an IBC. So when you're signing the balance sheet, you are actually signing off on the going concern for the minimum 12 months. The preparer is saying that, the auditor is saying that, but we had plenty of cases where financial statements were signed and within a few months, they were all coming through IBC. And in IBC, the haircuts which the lenders had to take was as high as 90%, 95% haircuts. It was too much of a financial risk which were adding to the financial system of the country. So it was felt that some responsibility should be cast on the preparers and on the auditors, to give some early warning signals in the financial statements, so that those red flags, people can be cautious about it in terms of their engagement and with the entity, whether as a supplier, as a lender, or whatever. And this includes adding some key ratios and all, and asking for an explanation for variance of 25%. In the case of listed companies, we have the MD&A. We have the management discussion and analysis, where you are required to, in any case, explain the performance last year, this year, all that kind of stuff. But we don't have something similar for unlisted companies. And please note, of the 14 lakh companies, listed companies are hardly 7,000. And large operating companies are at least 60, 70,000. The remaining 13 lakh companies, maybe they're just inactive companies or residual small companies, but there are at least 60-70,000 companies versus 7,000 listed companies where there is reasonable amount of business activity and there good amount of creditors exposure, operational creditors, financial creditors, and all of them needed to be given some red flags on what's happening as to whether the company will survive in the foreseeable future, whether there are any transactions which are Binami transactions, whether they are acting on behalf of somebody, pass-through transactions, all of those things. We had one set of amendments coming in there. Then for financial discipline, they had end use of borrowed funds, whether the money is being used for the purpose for which it is raised. And we have thousands of examples where money is raised for one purpose and used for another purpose. Banks try their best, but when collusion happens, you cannot stop it. But between the procurer and the bank, collusion can happen, but the auditor should be conscious that the sanction letter says end use is so and so, or is the company actually using it only for that particular end use? And on the end use, one very common aspect we all come across is working capital money being used for the assets acquisition, being used for long-term purposes. And typically when you do a fund flow statement, you'll find almost all companies which have run into financial difficulty, at least my experience, I can say nearly 100% of companies which have run into financial difficulties are those who have used working capital funds for expansion of their business, assuming that within next few months, term loan can be raised, within next few months, equity can be raised, but the next few months tends to become next few years, and it does not happen also because of change in so many other macro conditions and things like that. And those organizations who have diverted the money, diverted does not mean taking out money out of the company, in the company itself, but you use a short-term fund for a long-term purpose. And it is those situations where companies actually run into a financial difficulty. So those kind of diversions you need to capture through a fund flow statement. It was there in the old CARO 2003. It was a requirement in CARO 2003. It was removed in 2016, and now it's been brought back. Now it's been brought back to say where you are required as part of our audit working papers, we should have a fund flow statement where we should be able to see whether there is a diversion of funds happening, short-term to long-term, is it happening, and accordingly give a comment on the same. And then there are some minor edits which are done as part of this amendment. Like for example, the nomenclature in the income statement was total revenue from operations and other income. And we all know you have gains and things like that. Gains is not revenue, gains is income. So there are some small editorial corrections like that which had to be done, which was all done, which is the fourth quadrant. So all of the amendments which have been done keeping in mind broadly these four categories, and relevant for our discussion is the first one and the second one. The top one there on governance and the second one on early warning signals. Now, coming to promoter shareholding, we have a disclosure requirement of how much is the promoter shareholding now and what is the change in the promoter shareholding or change in the promoters themselves also. The definition of promoter is what you have in the Companies Act. Then comes the definition amendment relating to aging. And on aging, we have aging of payables. And this is a very interesting one because on aging of payables, I'm sure some of you have had some challenges in the March 22, March 23, you would have certainly been wiser. But if you look at the aging, if there are trade payables which are beyond 1 year, those trade payables will get recognized as a deposit under the Companies Act. And those deposits, since they would not be within the permissible limits, you would automatically have a violation of the deposit regulations. So there are many cases where people have suppressed profits or managed profits by accounting for expense and payables. So trade payables, there is no reason why somebody should have trade payables beyond a year, beyond 2 years, and beyond 3 years, because trade cycles are typically expected to be shorter unless you have a situation of financial difficulty where you are unable to pay, or there are disputes, or there are trade payables where there are disputes. So this particular aging breakup has been amended, has been brought in as a mandatory requirement for all the trade payables, and it also helps in the IBC cases as well. So when you go to insolvency cases, the creditors need to demonstrate their claims that this is outstanding for so and so date. So now if a company, like for example, I supplied some materials to you and it is already 2 years you have not paid me, and your balance sheet shows trade payables above 2 years as zero, 2 years as zero, whereas I say I have to recover the money, it is a clear evidence that either my invoice has not been accounted by you, or you have accounted it late, or the aging is wrong. So all this information will serve the suppliers who have to recover their money, also give them some insights or access on how the company is being managed and the recoverability of their dues. Similarly, we have the aging of trade receivables, and on aging of trade receivables, just look at it from a preparer and an auditor perspective. Earlier, it was less than 6 months, more than 6 months. And I know the many cases more than 6 months meant more than 2 years also, more than 3 years also. And companies were hesitant to make provisioning for those, hesitant to make provisioning for that. And as preparer or even as auditor in practice, we all struggled in quantifying the same. Now, when the company is mandatorily required to report that you have receivables more than 3 years, in such situation, if not the board, if not the audit committee, the regulator will definitely come back. Banker will certainly come and ask you, or the new lender will come and ask you. That information will become a very transparent information. And please note, this level of disclosure requirements are not there anywhere in the world. Anywhere in the world, whether it is aging of trade payables, aging of trade receivables, they are not there. But these are important. These are important because they are all signals. They are all indicators of the quality of governance of the particular company. If the credit period is 90 days, it can at best be 180 days, at best be 360 days. Beyond that, there is a need for making a provision. So the breakup of information itself will trigger the need to make provisions for those and bring the profit to the right levels, bring the equity to the right levels. It's very important to bring equity to right levels, because if you don't write off all these receivables, equity will be high, and then they will borrow more. They will borrow more. 2:1, 3:1, whatever, they will borrow more. Only if you bring the equity to the right levels, the borrowing will also be proportionate to the level of equity which exists in the particular organization. And consequently, the aging of trade receivables and all. And please note, MCA this is only 1 year since the amendments have come. MCA is just settling down. They are having some challenges with reference to their version 3 portal and all that kind of stuff. Once they are settled with those, once they are settled with all of those, they will have enough time to follow through with all entities with standard auto-generated mails, asking the companies and auditors to explain why receivables are above 3 years and provisioning is not there, why about 2 years and provisioning is not there. So those kind of questions will come, and if unsatisfactory or if material in their sense, they might commence investigation, etc. and all. So early days, 2022 has gone by, 23, we're all just in the process of finalizing. Need to be very cautious that this information is being gathered not for the sake of it. It is being gathered with a very clear objective that We want to have good governance in the country. We want to have a level playing field where people who do businesses with good governance are given the benefit of doing business better than those who practice poor governance norms. So it's from that perspective that these have been added. So that's on the receivables part. Then on the property, plant, equipment, before I get here, I just want to share one illustration to highlight the importance of governance. All of us over the last 10-15 years at least have been witness to the way the infrastructure has developed in the country. Look at the 6-lane highways and the 8-lane highways, which we currently have. And when people are following those highways, the lane discipline, the safety increases. If people are driving with lane discipline, it is extremely safe. You can drive at 100, 120, 140 when there's a lane discipline. And secondly, you are also able to go faster. So lane is a discipline, it's a governance. Lane is a governance, but it helps you to be safe. It helps you to go faster. It helps you to go faster. Imagine there are no lanes and people are driving haphazard. Here it is not safe and it will take more time to reach the destination. So all of the governance practices, when you tell somebody that you have to go in a lane, you have to park only here, you have to park it only at this particular kind of a position, all of those, they look a little irritating, they look disturbing. But if you just look at it from a very commonsensical point of view, everything which you do for ensuring good practices, they actually increase your safety, they increase the speed at which you can actually do your business. The same thing applies here also. All of these practices are eventually aimed at doing your business in a more safe manner and accelerate your business. Good governance companies, they get good premium from the investors. So with less dilution, you can raise more capital, more debt, more asset base, more revenue. So that's the entire objective of all of these governance practices. So coming back here on fixed assets, we had this requirement relating to revaluation of assets. Two reasons why this was done. There are some companies who are following the revaluation model, very limited number. But in India, it actually encourages organizations to follow the revaluation model for your property, plant, equipment, and even for intangibles. You have a choice of either cost model, which is historical cost, or you can follow the revaluation model. For most of us, instinctively, cost model looks a good model because it is historical cost. There is evidence of what has been incurred and the cost is there and you write down. But look at it from a user's perspective, somebody who is using a financial statement. For a user of financial statement, a 20-year-old company, a 30-year-old company, a 40-year-old company, the historical cost of your property, plant, equipment, that historical cost, or even the intangibles which are acquired and amortized fully. So that historical cost information is irrelevant because it does not communicate anything about the value of those assets to the business. In a revaluation model, through an assurance process, there is a valuer, regulated profession, there is a audit committee board, and there is an auditor. Through a regulated process, you determine what is the fair value of those assets, and the assets get reflected at fair value. So the user will get to know that these are the worth of the assets of this organization. Otherwise, the investor, the user is speculating. He's speculating that probably assets are worth so much, probably these assets are these values. So he or she is speculating. Whereas the moment you follow a revaluation model, you are communicating through a reasonable assurance process that these are the fair value of assets which are there for the
business enterprise, and you're reducing the speculative element of how much is the value of those assets. The second aspect, which is a very important aspect, is in a revaluation model, the profit on revaluation does not hit your income statement, does not hit your income statement. It is not available for distribution, etc., etc. It just goes and sits as a separate reserve in the other comprehensive income, or AS business, it goes to revaluation reserve. So it just goes and sits there. It's never available for distribution, except when to the proportion of depreciation, you can write back. To that extent, the provisions allow the same. But the third and most important reason of why a revaluation model is a relevant model, why a revaluation model is a relevant model, is the following. If you look at income statement, you have revenue, sales, which is based on price levels of the current year, 22-23 price levels, revenue figure. Cost of materials consumed, purchased in 22-23 reflects the current year price levels. Employee cost, establishment cost, SG&A, all these have been incurred in the current year, 22-23, and reflect the price levels of 22-23. Whereas depreciation, which is another important element of cost and a major element of cost, particularly in capital intensive industry, that depreciation is based on price levels of 4 years back, 7 years back, when you bought the asset. So income is at one price level, some of the expense are at that price level, but depreciation, which is another important factor, is at some older price level. So because of this, in an inflationary economy, where inflation is 6, 7, 8%, imagine 4-year-old asset, 7-year-old asset, you're effectively providing depreciation, which is 20% lower, 30% lower, 40% lower than actual cost or worth of the asset which you are consuming, resulting in your profit figure being higher. So because of which your reported profit is high and the risk of distribution is also high. Whereas if you follow the revaluation model, the depreciation will be charged based on current price levels. So in the income statement, every line item will be based on the current price levels, and profit will represent what is your current price level. And the important benefit of this is all of us are in the business for a going concern basis. So if you bought assets worth 100 crores 8 years back, I've replaced that asset now. When I replace that asset now, the amount of depreciation I provided on historical cost basis is only 100 crores. But in an inflationary economy, to replace that asset and have the same capacity and to maintain the same revenue and to be at sustainable level, I have to invest at least 150 crores. So which means what I recovered using the asset is only 100 crores, whereas I require 150 crores. That again becomes a reason as to why businesses fail. This again is an element of governance. So governance includes how businesses can be sustainable. While profits you may report the way you want, you need to ensure that you are capturing the right kind of cost, holding back accruals which will be required for the purpose of replacement of the assets. So in that context, the revaluation model is relevant. So what this provisions provides is, in the context of CARO, where auditors have to report, you are required to report as to whether it's been done by registered valuer, and if the valuation is more than 10%, you should tell for property amount is so much, land so much, this so much, that category wise needs to be given. And as a preparer, in the main financial statement, you are required to give a disclosure of whether it is tangible or intangible assets, what are those assets revalued, the classification, the criteria for selecting the revaluation assets, the registered valuer engagement, and how the accounting treatment has been done. Then another aspect relating to property, plant and equipment is title deed of immobile property. This is extremely common and there is nothing which people have to be defensive about it. So in practice, there are plenty of cases where company will own a property, but title deed is not in its name, not in its name. Genuine reasons can be land has been allotted by KIADB, but they will give you title deed only after you complete construction, functional certificate, etc. So till then you don't have a title deed, but you paid for it and you're showing it as land. Another genuine reason, you're merging a company, you're merging another company with you. So that land has come to you according to the scheme of amalgamation. That land is yours, but the title deed is not in your name because it has to go through the registration process, etc., which will take 6 months, 1 year, 2 years. My experience, I have come across some industrial development corporations where it has taken even 3 to 4 years to get that final approval. So those cases, you are required to say that this is asset in my books, but I don't have the title deed, so and so reason. But there are cases which I have come across, I'm sure you have come across, where asset is purchased in the name of a director. Asset is purchased in the name of a director. Company has bought it, company has paid for it, it is shown as land here, but it is registered in the name of director. Whatever be the reasons, there are several practical reasons why people tend to do that. So what this particular provision says is, look, any such cases, you disclose the fact that the asset is not in the name of the company. That's a disclosure requirement which has been made essential. And then on capital work in progress, including intangibles, development work in progress, I've already told you at the start, aging analysis needs to be given. And here again, nowhere in the world, we have a requirement of aging analysis for capital work in progress, but this requirement has come. And in audit committees and boards, I am seeing people actively watching this number. Earlier, capital work in progress, one number, nobody ever bothered about it. But now when capital work in progress is there, beyond 2 years, beyond 3 years, there are directors who get concerned. They ask about the status of those projects, why you're still carrying it, why are you not writing it off, why are you not impairing that project? Those kind of questions and conversations are happening now. So both for tangible and intangible needs to be given. We also need to give information of time overrun, cost overrun, which means every company where you are working or you are an auditor, they should have part of the documentation, board or management documentation. We are taking this expansion project of 10 crores. Estimated timeline is 18 months. There should be that document. And if it is crossing 18 months, you have to disclose it. If you are exceeding 10 crores, you are required to disclose it. And if you just look at our own experience, particularly for some of the family managed businesses or little proprietary type of company business and all, most cases you'll decide setting up a plant without even having a proper document on what is the breakup of cost to be incurred, what is the timeline to be incurred. If you go for a bank loan, well, the bank loan application or the bank documentation will have some information of estimated timeline and the cost. But if it is self-funded or through unorganized source funding, that documentation will also not be available. So it is imperative for us to ensure that the documentation is there, and the guidance note of the institute provides that if such document is not there, for you to find whether there is an overrun, you have to state the fact that there is no specified timeline, there is no such document. So that information needs to be given. So this is on the capital work in progress, both tangible, intangible. And one more disclosure on this is projects which are suspended. The mini expansion projects, people start, some approval is pending, environment approval, whatever approval is pending. I already spent 3 crores, I already spent 30 crores, and it is stuck. So if any such projects are suspended, the details of those projects suspended should also be given. My reading of the annual reports of March 22, I didn't find too much disclosures here. People are still just taking it a little light, but let me share with you, MC will get back very strongly on this. And please know, suspended project means testing for impairment. Suspended project means testing for impairment. I already spent 30 crores. Project is suspended for last 6 months, 1 year, 1.5 years. Nothing is progressing. So I need to test it for impairment, state evidence that there is no impairment, or if there is impairment, yes, I have made accounting for the impairment. So that's the other requirement which we have as far as Schedule 3 is concerned. This is on the intangible assets. Now, as far as Binami transactions are concerned, here again, both in the Schedule 3 and in CARO, in both these documents, there's a requirement of whether there are any Binami transactions and whether there are any actions initiated against the company or where the company is a party for any of the Binami transactions. Now, on these Binami transactions, the only way we can find out no company is going to come and tell that action has been initiated on Binami. So it's very important to ensure that the legal bills which get paid and all, they have to be scrutinized very carefully, including after the balance sheet date, why those legal bills have been paid, the legal consulting which has been done. Sometimes the legal consulting can get masked in some other head also. You have to be very careful. That is only evidence for you to discover whether company is transacting or is engaged in resolving any Binami notice issue. No company will come and voluntarily tell. We have to find out our own audit procedures to discover whether there are any such notices or where the company is a party for such Binami transactions. So, and then properties which are held as Binamis on behalf of others. So those also need to be disclosed as part of the financial statements. Then on working capital, there are two things which have come in, and these two things are, one is physical verification, variance about 10% you have to disclose and all. But the second one is a tough one. I don't know how all of you are managing, but at least my view, it's a very tough one. On a quarterly basis, particularly for unlisted companies and all, where we don't prepare quarterly financial statements. We don't prepare quarterly financial statements. Listed at least, we prepare quarterly, get it reviewed and things like that. Where your working capital limits above 5 crores, and almost everybody has it in these days. So those working capital limits, you file your stock statement, receivable statement, inventory, whatever, whether they are reconciling with the books of account, And all of us know the accrual entries. Accrual entries are all typically passed only when you close the books of account, whether it is inventory work in progress, or whether it is unbilled revenue for service contracts which are there. So all these typically come through only an audit process, and smaller companies, they don't have a practice of raising those invoices necessarily on a timely basis, but they use those receivables for the purpose of obtaining bank drawing power and things like that. So what the second clause requires is the preparer should tell that our working capital limit is more than 5 crores, and whatever we have filed with the bank is tallying with the books of account, and the auditor in CARO has to confirm, yes, it is tallying, yes, it's tallying. So these are very stringent provisions which have come in, and I think all of us as professionals have a responsibility here. If you look at the banking system, with a lot of difficulty, it has got relatively cleaned up as of March 23. If you look at the overall NPA levels across the banking system, they've reasonably come down. Can it be better? Yes, but my view, in a developing economy, there will be some amount of bad debts always. Without bad debts, the question of risk will not happen. So there will be bad debts, but it's come to a reasonable level. What is important is we all should travel along with the other stakeholders to ensure that we don't go back to those earlier days where we had this unreasonably high kind of NP levels. So all those unreasonably high NP levels basically means the depositor is bearing the cost. All NPS is borne, the loss is borne not by the bank management, not by the bank shareholders. It is actually borne only by the bank depositors like you and me in the form of a lower rate of interest. So if normal entitlement of rate of interest on a pricing model would have been 7, because bank has to absorb additional costs through this bad debts, they pay you and me only 6%. They pay you and me only 6%. So as far as the bank management regulation, nothing changes. Shareholders' profit valuation, share valuation, nothing changes. And if you look at the last few years, to the extent your memory can recall, you will notice that the rate of interest you get on your deposits is less than the rate of inflation, which means you are effectively sacrificing your principal amount. And just look at the large public who doesn't understand finance, all of them are bearing the brunt of this NPS. And it is for us collectively to ensure that we don't go back to that state. All of us are responsibility to society. And these clauses are basically intended to ensure that businesses run in a reasonably well-governed manner. And if the red flags come up. After red flags, somebody doesn't act, I think we can't help it, but at least we have done our duty in terms of highlighting the relevant red flags. So that's on the working capital. So what it says is, this is what the preparers have to give in the notes to accounts. The previous slide was CARO, what auditors need to give in. This is what the preparer needs to give in notes to accounts to financial statements, whether the quarterly returns are tallying with the financial statements. If there are discrepancies, you need to give a reconciliation of the same. Then, willful defaulter and end use of funds. As far as this is concerned, this is again a reporting requirement. In CARO, auditor has to tell, and next slide, preparer also has to tell whether the bank or financial institution has declared an entity as a willful defaulter. And who is a willful defaulter? There's a definition of RBI as to who comes as a willful defaulter. So, and that list is published in the RBI website as well as an audit evidence for us to check. So if you are a willful defaulter, that disclosure requirement is there. Then we have a disclosure requirement of whether the loans have been used for the purpose for which they have been raised. Recall, I told you at the start, in CARO 2003, this clause was there. It was withdrawn in 2016, and now it has been reintroduced, where as an auditor I have to certify whether the loans have actually been used for the purpose for which they have been raised, and then whether short-term funds have been used for long-term funds. Recall the discussion around fund flow statement, which I told. Fund flow statement, this requirement was there in CARO 2003, withdrawn in 2016, and now reintroduced. So as far as your audit working papers are concerned, you should necessarily have fund flow statement. We give cash flow statement as part of published accounts. That is mandatory. But fund flow statement basically shows long-term source, long-term use, short-term source, short-term use. And from that fund flow statement, you should see whether there is any short-term source going for a long-term use. And if it is going for long-term use, then this reporting requirement comes up. So without fund flow statement, your working papers will be incomplete. And every client, you need to have this fund flow statement as part of working papers for you to comment on that particular para of CARO. So willful defaulter, as I told you, it's a RBI definition of who is a willful defaulter. Preparer has to disclose from which date they have been identified as a willful defaulter and details of all the defaults which are there. And then, solvency. As far as solvency is concerned,
I don't know how many of you can recall. Normally, if you look at it as a behavioral trait, you ask somebody to sign something once, you tend to sign off, it's okay. Then you say, I reiterate the above, I reiterate what I've already done. You tend to think a second time, You don't sign at the same speed at which you signed the first occasion. If you look at going concern, it is so fundamental to financial statements and audit that any financial statement which you prepare, except when you are making a specific disclosure, there is this fundamental assumption that there is a going concern, which basically means the preparer has assessed, the auditor has assessed, and they are convinced that this entity will survive 12 months. So this entity will survive 12 months. That assessment we are confirming the same. Now, when I'm already confirming by signing financial statements, why should I reiterate this? Caro, and even in notes to accounts, preparer. The reason is the signature aspect which I told you. When you have a specific clause which tells the auditor that, look, are you sure this company will be solvent enough to take care of next 12 months liability? You'll be a little more guarded. When you prepare, you are very comfortable. But this clause, when you read and you have to sign, you'll think 2-3 times. What is their position of current assets, the realizability, how much liabilities are there, how much is becoming due? You'll think twice, create enough working papers before you are convinced that, yes, okay, I can sign off on solvency. So this paragraph has been introduced to ensure that auditors are applying themselves effectively when they are signing off on the going concern basis. And please note, this kind of a signing off cannot be done unless you have a good understanding of business and a good understanding of post-balance sheet events. I'm signing in June, July, August, post-balance sheet events, how those receivables, payables are all getting retired and all. Unless you have a good understanding of that, you will not be able to sign off on the solvency of an organization that will survive 12 months. Recall, I told you, there are plenty of IBC cases where auditors have signed, company is solvent March 2018, August 18, the date is report is signed, and October they are filed for insolvency. So that can never be the case unless there is some huge external event which comes and hit you. In a normal situation, it is very unlikely that I sign a going concern and within few months an entity has to go through an IBC situation. So this is a very critical one, again, to improve enhanced governance in the business. So this is a requirement where auditors need to confirm and they need to get a management representation, evaluate the same and all. And on management representation, some of you might have heard me on this, but at the cost of repetition, management representation, unless you have validated the contents of the management representation, which means you have verified and satisfied yourself, and there is evidence of the same, and that you have used it in your audit opinion. Unless these two things are there, I repeat, one, whatever management representation you get, there should be evidence that you have verified everything they have said and satisfied it is correct. Second, there should be evidence that you actually considered this in forming your opinion. Unless these two things are there, management representation is like a toilet paper. It is no protection to you. Many have this impression that I got management representation, so I'm comfortable, I'll sign off. No, management representation will be an audit evidence only if it has passed these two tests. Otherwise, it is of no relevance at all. It is as good as not collecting, So while the guidance note says management representation should be taken,
but you have to satisfy yourself about every representation which they have made. And then disclosure of these ratios, and so 11 ratios which are there. For NBFCs, we have extra 3 ratios, and variance of more than 25%. Either way, you have to explain, and these are not going to be easy. These are not going to be easy, and you should not in the process try to manage the variance also. You have to be very careful on this. So these are the 11 ratios which you are required to give. And intercompany loans, this again new requirement for governance brought inside CARO and also in the preparer. This is CARO auditor responsibility. Next slide is preparer responsibility, where there would be instances of company receiving a loan and giving it to subsidiaries, joint ventures, associates. So if there are any such loans which are there, you have to report on the same. Similarly, if you have pledged any or mortgage or created security on your investments in any of those entities, also you are required to report. You are also required to report situations where I give a loan to company X, telling that please give it to company Y. So I give a deposit, intercorporate deposit, whatever. I say I have surplus money because intercompany loans, there are limit 60%, all that kind of stuff. Or I want to bypass the related party transactions. So if I give the loan to somebody as a deposit or whatever form I give it to him, and that money is used for lending to somebody or a trade advance or a guarantee and all. So those cases also needs to be received. Similarly, the company is receiving it is also required to report. So these are reporting requirements which have now been added. So this is what I was just telling you. Transactions where an entity has given a loan to another person and transactions where it is received. So both of these have to be reported, and just look at the underlined portion. Underlined portion, whether recorded in writing or not. So what is very important is I have given a loan to him saying in writing, this money you can use it as security and give there. That is in writing. So in practice, there are many instances where it is not in writing, but there is corroborative evidence of the same. Corroborative evidence of the same. For listed companies, SEBI is enforcing it. And in CARO, unlisted company, private limited company, unlisted public company, all of this is applicable. Even if it is not in writing, if there is corroborative evidence, you have to take cognizance of the same. So the entire advances portfolio, loans portfolio, the partner level involvement is extremely important, because unless you have the right quality of questions to the auditee, you will not be able to figure out the routing of money which happens. So those are, this is for loan given, this is for loan received. And again, I'm highlighting the underlined portion, whether in writing or otherwise. Now, there are other compliance requirements. I'm sure all of you have experienced this relationship with stuck off companies. If somebody stuck off has put money in you, or you put money in a company which is stuck off, or I got materials or gave material to a company which is stuck off, all those disclosure requirements are there. Charges, if they have not been created or charges have not been filed, you have to report the same. Please note, none of these have anything to do with the balance sheet, financials, asset liability, income expense. All these are focused only for ensuring enhanced governance and the trust of MCA on chartered accountants as preparers, audit committee and board members, and on the audit practicing community, that these things, they'll be able to bring it out more effectively and help better regulation in the country. And I just want to share one more point. Some of, while these are very odd to India, there are other countries who are actually thinking on these lines. While we did all these things, nobody in the world has done it. There are other countries who are actually looking at these practices because they also have similar situations. Not that India alone has all this misgovernance, they're world over. Now, there is one requirement coming in IAS 1. In this one, that is for us IAS 1. And that amendment is applicable internationally from January 2024. And in India, subject to Council and NFR approval from April 24 or April 25. Now, what this amendment says is in case 1, presentation of financial statement, current, non-current. What it says is, if I have taken a loan, the loan has some covenants. Every loan has some covenants and all which are the clauses. Now, in the covenants, what you would normally negotiate at times is, I am in the initial years of my journey, formative years of company. So formative years of company, maybe the loan will tell debt equity ratio of 2.5 is allowed. Debt equity of 3:1 is allowed. But 2 years from now, your debt equity should be less than 2:1. So there are covenants which are applicable for March 23. Their loan already taken and covenants applicable for March 23. And there are some covenants for the same loan, which I should fulfill 1 year later, which I should fulfill 2 years later. Now, March 23, it says, for example, debt equity 3:1, and I'm fulfilling it, then I will treat it as non-current liability. But if I breached it, my current ratio is, let's say, 4 or debt equity is 4:1, I breach a covenant, bank has the right to withdraw the loan. They have a right to withdraw the loan. So loan should be classified as current liability. So 3:1, I classify it as non-current. But the loan agreement says by March 25, my debt equity ratio should be below 2:1. So that is only March 25. Now, what the proposed amendment originally said is, if you are unlikely to meet the covenant in March 25, if you are unlikely to meet in March 25, then in March 23 balance sheet also, you classify it as a current liability. But after a lot of deliberations across the world, they've come to a mid position, which will get notified now, where they've said that if you are unlikely to meet the covenant by March 25, which you have agreed in black and white, 10-year loan, you have agreed in black and white that by March 25, I'll bring the debt equity ratio as 2:1. You have to disclose in March 23 notes to accounts that I am required to reach the debt equity ratio. I am unlikely to reach. I am likely to reach. That predictive aspect you have to bring in. And please note, preparer, auditor, both have to sign off. Preparer, auditor. And many of us struggle for outlook 3 months from now, 1 year from now. These are all cases where, of course, business plan, all the stuff will be there. But our ability to understand businesses, how the business plans are drawn, the integrity of those business plans, and the ability to confirm that the company is likely to meet it, not likely to meet it, will be a requirement. That requirement is coming now. The point why I'm highlighting that is because it's not just in India, even globally, they're trying to say that while historical information is there, that is yesterday, it's all gone. The financial statement should also give some amount of predictable information, more so because of the going concern element. It might be difficult for you to digest, but it is imperative, unavoidable, that we have to scale our capacity to meet that ask. I'll give you a very simple example. Let's take our own personal lives. Today, if I want to go to airport now, for me, what matters is not the distance of 43 kilometers. 43 kilometers is historical data. It's historical data. Geography, somebody calculated back. That is irrelevant for me. What is important is, if I leave now, I'll reach in 1 hour 45 minutes. If I leave at 2 o'clock, I'll reach in 2 hours time, whatever time. So what is relevant for me is the predictable information. So based on the experience of the past, which has been accumulated, the predictable information. So users of financial statement want only the predictive insights for the future. They don't want historical anymore. So for you and me, we might find it difficult to say that how can I predict and tell, but we don't have a choice. Whatever combination of tools we might use over the time, maybe 3, 5, 10 years, we have to get to that stage. Otherwise, financial statements will become irrelevant. People will not even look at financial statements because they'll tell historical data. Why would we look at it? I just want to know how much time it takes for me to reach now. Just tell me that. So that's how the financial statements are taking shape, and the same is applicable here as well. Scheme of amalgamation, whether you have come, or scheme of arrangements, whether the terms have been complied with, CSR, all of that. I think you had a session as well. I'm almost at the end of time, so let me just come to the last couple of slides and conclude. I talked about NOCLAR being effective from October 22. It is applicable for chartered accountants in industry and in practice. And in industry, it is applicable for senior accountants, senior professional accountants, that is typically CFO, financial controller, head of finance. So those kind of people. And for audit practitioners, it is applicable to the entire engagement team, not just to signing partner, to the entire engagement team for audit practitioners. For as far as the industry is concerned, for members in industry, it is applicable for all listed companies, whereas for those in practice is concerned, it is applicable for listed companies with net worth above 250 crore, 250 crore and above. In a phased manner, they will make it applicable later. What does NOCLAR require us to do? If you come across a non-compliance of a law or regulation, which will have a material impact on the financial statement or on the going concern aspects of financial statements or continuity of business, you are required to bring it to notice of the respective regulator. So it will not cover any of the personal laws and things like that. What is important is to sensitize all the members concerned about this obligation which is there. So with this, let me conclude, and whatever time I had, I tried my best to share with you the Schedule 3 amendments in particular in the context of how it seeks to address the improved corporate governance. And while governance would mean difficulty, pain, but as I told you, well-governed companies, the speed at which you can grow and the safety with which you can grow is assured. So with these words, thank you all for patient listening. Pleasure being here. Thanks to Divya and team for the invite.
As a leader of representing the institute who has privy to the expectations of the government, and as a group CFO for a large entity and vast experience of over 3 decades, handling many group large entities, both as auditor, auditee, and member of FRB and QRB, along with more than 2 decades of teaching experience, can only bring that what is expected out of CAs, be it auditors, employees, or board members. A big round of applause for the wonderful sessions. On behalf of members present here and all the managing committee members of Bangalore branch, would like to hand over a memento as a token of respect and gratitude. Can I request CA Manjunath, hello, Secretary of the branch, to present the memento to the speaker. Also request Pramod Hegde, Vice Chairman, to join for the photograph. Thank you, sir. Thank you, members. Now we will break for the coffee and reassemble sharp at 11:50 AM for the next session.